Hey guys, this is Market Update. Crypto obviously likes these rate cuts. Why not? There's still a lot to come. We're still way too high for rates, way above the inflation rate. So more rate cuts are coming. We've clearly put in a support zone around this red box that I put a long time ago. We have some risk taking back into the price. I think if we break into this 64 zone and have support there, that's super bullish. And that sets us up for a break of this range. No one knows what's going to happen. There may be a bit of euphoria and then a bit of a collapse. I think we should still be buying Bitcoin here, especially all the way into this 75 zone. I think we break out of that end of this year, sometime next year, it doesn't matter. So that's that. If you do trade crypto, $30,000 deposit bonus on Bybit, check the link below if you don't have an account yet. Sign up, deposit, you can get that deposit bonus to trade. What we're gonna focus on in this video is what I'm working on for the crypto course, which is much more in-depth investment stuff. And I wanna go through that in this video because this is the important thing. Buying Bitcoin still, because we have a massive bull market ahead of us. This is BlackRock's squiggles that they're making, and these are starting to look a lot like my squiggles that I put on the chart. Now, my squiggles are showing a Bitcoin price in 2033 about 400K. Why? I'm going to explain that in this video. This is an investment framework for BTC. I'm going to make this as concise as possible to fit into a YouTube video. If you don't have the crypto course yet, I'll link it below as well. You can see all of these videos on getting set up in crypto, and I update it for free for existing users forever. So if you have the course, all of this is free. If you don't have the course yet, check the link below. The price does go up as I add course material, but if you're in, that's it. So let's talk about what the real investment case is here for BTC and why it's desirable versus a lot of other assets and why it's going to monetize. So we need to keep buying it, even at this level. So this is the trade, the Bitcoin trade, the investment trade in property or stocks or BTC. What you're doing is taking your value out of the fiat currency system. This is money supply growth. There are many ways to try and see how money supply grows. M2 is one version, but there's also M1 and other things. Look, just the point I'm trying to make here is that money supply growth over time in the fiat currency system is positive. If you look at the average, it's around 7%. So you can see positive areas of M2 growth, right? So all I want to say is, if you're measuring assets from the fiat currency system, which all of us do, because we're all looking at the price of Bitcoin and we're all saying it's $63,000 fiat currency units, okay? So fiat currency units expand about 7% a year over the long term. So if you're in those currency units, those are expanding by 7% a year. That's not good. So we need to get out of that and be in things that don't expand, because if you're measuring those things in currency units that are expanding at 7% a year, and that thing remains just the same amount of demand, then supply and demand dictates that that thing goes up 7% a year in the currency units. Or if you don't own it, then that thing is getting more expensive by 7% a year if you're owning the currency units and you don't have the asset. This is the basement. This is the basis of investing, is we're actually not investing in a thing. We are escaping the fiat currency credit unit system, which is debasing itself by 7% a year. The reality is that the credit unit currency supply grows around 7% a year. All right, that's reality. It's not good or bad. It just exists. So if you have those currency units, they're actually expanding by 7%, meaning that everything else that isn't growing at 7%, maybe it's growing at 4% or 3% or 1% or 0%, they have to price in that 7%. Right? So desirable assets with lower inflation can price in the growth of those currency units. Currency units will buy less over time because they expand in relation to things that aren't expanding as quickly. So what assets do you want to be in, and are they expanding at the same or a lower rate than the credit currency units? Credit currency units, fiat currency, are necessary for payments of goods and services because the government makes legal tender rules. Legal tender rules are designed to keep people in that system of taking those currency units out, paying those currency units off. Holding them for any length of time will reduce the purchasing power of those units versus goods, services, assets. 7% growth in currency units, 0.9% in Bitcoin, which is scarce desirable asset. What do you think is going to happen to the price? Obviously, it's going to go up if we assume the same supply and demand characteristics. This system, the fiat currency system, is not good or bad, it just exists. Fiat currency is not money, it's not an asset, it's a bank's risks. They literally create the currency units and give it to you as risk. They create an asset on their balance sheet, a liability on yours, and you're supposed to pay it off. If they take that risk on you, great. You now have these currency units which are expanding at 7% a year. So what? As long as you can pay off the debt, great. Right? And it's the banks that's making the vig on that because they're charging you an interest. But those currency units are not an asset. We should not be holding them for anything other than taking debt and paying that debt off. work for them. So you can work for them, earn them, you pay the debt off. They're not an asset, and so we need to get out of them if we have savings. USD is the preferred way for risk takers to take risk and account for risk. I'm talking about banks here. Banks enjoy using the dollar. It's the most liquid. It's got the most network effects. Okay, so they take risk in dollars. They want dollars back. Fiat currency is not money. Let's talk about assets. We know we have to escape that. And now what assets can we buy? Okay, so Bitcoin annualized returns is 143%, up about 43% this year. It's actually up around 50% because we've just jumped this week. Anyway, 50% best performing large scale asset. Gold up 24% this year, very, very good. However, annualized for the last, 10, 12 years, you're looking at 4%. Okay, so 4% annualized return, that doesn't keep up with the amount of credit unit expansion. So it's actually got a worse return, right? So if the currency units are expanding 7%, but gold is returning 4% in those currency units, gold is actually losing purchasing power in those currency units. So it's not a good investment. Then we're going to look at the S&P, which is 13.6%. And then we look at REITs as well, which is real estate, around 8%. Okay, so if you want to get out of fiat currency units and actually have some savings, you need to put them in assets that are debasing themselves at a slower rate than the currency units. So REITs, about 8%, is the same pace as credit currency units. We're looking at the S&P, which is actually a little bit better. Gold is worse, and then Bitcoin is obviously the best performing large scale asset. Those are the assets we can look at. There is basically nothing actually desirable to invest in and hold. Okay, money, you don't want to hold that for any length of time. Yes, you can use that to buy goods and services. That's the fiat currency credit unit system. Then we've got bonds, real estate, equities, and basically this stuff, which is alternative asset Bitcoin, gold, art, cars, collectibles. Art and cars, collectibles, no, they're not real investment, right? So let's look at these asset classes and the pros and cons of them. Government bonds are an absolutely terrible investment. So I'm going to take the ARR, the annual rate of return of bonds, around 3% if you have them, right? So they lose purchasing power over time because the rate of currency debasement in those credit currency units is 7%. And I'm going to put some gov stimulus on here to bring the rate of currency debasement around 8% a year, right? So if the rate of currency debasement is 8% a year, that is your hurdle rate. If bonds are giving you 3% a year, the government is literally stealing your money through currency debasement. So they're paying you less interest than they're debasing the currency, and that's how they keep their debt costs low. If you buy bonds, you're going to lose purchasing power over time. What we can do, though, is use money market funds with no lockup as a midterm cash balance. Because all of our costs are in the fiat currency, we have to keep a part of our portfolio in that in order to pay for our costs, mortgage, car, etc., right? Old people can benefit from holding bonds as they have less time to worry about the loss of purchasing power, and what they need is certainty of cash flows at their age. If you take the 3% in bonds and you minus off the debasement rate plus government stimulus, you are losing money each year in bonds. However, of course, they are used for cash purposes, which is obviously important and necessary. Now let's get on to real estate, which I think is a decent investment for a lot of people and not for others. It depends on the real estate market where you are. Real estate average rate of return or annual rate of return is around 8%. That's from this list right here. So let's take that 8%. 8%. Real estate is a physical depreciating good, and it should become cheaper to produce with technology. Some real estate may be more desirable if an area is in demand, right? So if you buy a piece of real estate and you think in 10 years' time that area will become comparatively more desirable versus others, then more of other people's assets will flow into that area, pushing the price up faster than other areas. But over an entire economy, real estate should not really grow your wealth over and above the rate of currency debasement, because real estate is a currency derivative, because everyone buys it on leverage from a bank, which is the bank taking risk, creating those currency units to you, expecting them to be paid back. So is real estate an investment that actually makes money? I don't think so. I think that money in real estate is made from the arbitrage between the rate of interest on the leverage that you take from the bank and the rate of currency debasement, which is 8%. You are not making money on the real estate, because we can see from real estate that it goes up 8% a year. So if the currency debasement rate is 8% and real estate goes up 8%, you're not making any money. However, if you are taking a loan out with massive amounts of leverage that is underneath the rate of 8% currency debasement, then you're making money on that arbitrage. So real estate ARR is 8%. Maybe you put a 10% deposit down in a house, that's $50,000 if the house value is $500,000. Mortgage rate is 5%, let's say. So you've got 8% currency debasement rate, which property price is in because it debases at a slower rate than that 8%, right? And you've got the minus 5%, which is your cost, so you're making 3%. But you're not just making 3% on the amount of your deposit, you're making 3% on the amount of the house, which the bank is giving you massive amount of leverage for. So a house is really the only way that any of us take massive leverage in an asset. right? It's the only thing that we can get huge leverage for. You can't go to a bank and say, give me £500,000 because I'd want to put it in the S&P. They're not going to do that. They only give it to you in real estate. And that's because you can't move the thing, right? You can't send it abroad. You can't leave. It's right there and they can take it back from you. So that's why they give you leverage on it. The leverage system is the thing that people are making money out of. You make the money on the difference between the rate of interest on the leverage and the rate of currency debasement that the asset price is in. That's important, right? Because real estate ARR is 8%. Okay, so we're not making money on the house, we're making money on the difference in leverage. It's important because not everyone can get leverage. Okay, if you're a young person or you don't have a college degree, bank may not give you leverage. If you're an old person, you're not going to get leverage. If you're from some section of society that the bank doesn't want to deal with you, you're not going to get leverage. So leverage works if you're rich and you can go to the bank and they give you loads of money and you can take the vig between the currency debasement rate and the rate of interest. So great, if you're rich, you're going to get richer because you can take leverage on the house, no problem, as long as you can afford the repayments. So as an investment, it's great if you can take leverage, but if you can't, real estate's not for you, right? So you have to find something else. What is that other thing? Real estate should get cheaper over time as we build plentiful supply. Just like TVs, just like cars. Cars are getting more expensive, but the rate of the rise in price of cars versus the house, right? So if you go back 50 years, a car was worth almost as much as a house, and now it's worth much less. So actually technology is bringing those down because no one wants higher car prices. Everyone wants higher real estate prices if they're in real estate. People who own property tend to be older, richer, more powerful, and vote. Property owners will therefore lobby government to create regulations that prevent housing supply increases. Rules such as air rights in New York will create artificial supply limits on supply, which in turn help buoy prices, right? So what we're doing here is we've got an amount of people that own real estate who are usually more educated and wealthy because the bank's giving them leverage, obviously. And they give leverage because maybe you went to a good school or you have a good job, etc. So you have these people who are mostly more rich, a little bit older and slightly powerful, and they have the power to lobby government for rules and regulations that prevent the free market pouring supply onto the market, bringing the price down. That's actually pretty good news if you're a house owner, right? So fair play if you can get it, right? If you're a house owner and you can do that and you can lobby the government and you can lobby the Fed to print money. So when the housing market actually collapses, you can just lobby the government and they're gonna print money and they're gonna buy all the mortgage-backed securities of the bank and push the price up again. So good for you. Currency debasement is working in your favor. So if you're a property owner, hey, if you can get it, great news, right? Real estate only works if a bank will give you 10x leverage on your ability to earn income, right? And pay back the loan. So if you can get leverage on a house, brilliant. And if the house is in a good area, which mostly desirable over time, great for you. If you can't get a mortgage, okay, you can't benefit from this arbitrage and you're stuck. Right? So real estate is a decent game to play as we need to live somewhere anyway, but only available for certain sections of society. So if you can't play this currency debasement game, taking 10x leverage and getting that difference and that arbitrage, what can you do? The first option is to invest in equities. I've got nothing against equities, especially large US dollar-based indexes like the S&P and the NASDAQ. Very, very good, solid indexes that are going to protect you from inflation. Great companies. You know, I was a stockbroker, so I know about equity, and you know, it's not a bad thing. It's been a very good store of value for a very long time, right? Why? Okay, so you have businesses that can protect against currency debasement. They're going to up their prices, they're going to cut their costs, etc. So you have a group of people that are going to protect themselves and their shareholders from currency debasement. So if prices go up on the shelf, as long as you're an investor in those indexes and those companies, it's not really an issue, right? So if prices go up and companies make more, that means the share price go up, and that means your ownership of them and the amount of wealth that you have also goes up. So as long as you own equity, then it doesn't really matter what prices are because you're always going to be pricing that in with your own equity and your ownership of that. Equity is a good store of value over time, or it has been over the last 10 years, right? 12 years, what we're looking at. So a very good way to protect against currency debasement. And currency debases, the government stimulus distorts prices, but corps will adapt to produce the same profit margins, okay? We've seen that, and it bears out in the data. 14% is the S&P return, minus a currency debasement rate. You are making a positive return in the S&P, about 6%, right? So if you own stocks in a non-USD market, that's not good because the USD is really the strongest currency and everything is traded in USD. So if you've got FTSE shares in the UK, what you're going to have to do is you're going to have to take that, what you're making, and then you're going to have to convert it into USD because most of your costs are going to be in USD because you're buying things, you know, commodities, etc., in the foreign markets based in USD. That's where your purchasing power comes from. So that's what you have to do. But look, equity is decent. Okay, it's good. Those indexes have worked, and owning equity in those companies that can protect from inflation is pretty good. Many will say that gold has protected its purchasing power as well. Kind of. The average or annual rate of return is 4%. Gold inflation rate is 2%, which is better than fiat currency. But if the annual rate of return is 4% and currency debasement is 8%, you're actually making a loss, right? Because gold isn't really very desirable, especially among younger people, and its inflation rate is 2%, which isn't really great, because if you're looking at the stock market, the best stocks actually buy back their shares and cancel the shares, which is making them more scarce in relation to the profit margins. That's how the companies are trying to capitalize themselves, which is making profits in that fiat currency and buying back their own stock, trying to capitalize their company. But what if there was a different type of capital that they could actually invest in? Bitcoin is digital capital, right? And it has a lot of desirable characteristics. Now, it's not the be all end all. You know, Maxis will say it's the only thing that's going to have value. That's not going to happen, right? There are going to be other assets that people enjoy. But essentially, Bitcoin is somewhat desirable, and it has a lot of desirable characteristics that it only has, and a lot of other assets don't. So as long as you believe that Bitcoin is going to remain somewhat desirable over the next like 20 to 50 years, right? And it's not just going to fade away, then it has to be part of a portfolio, right? And it has a lot more desirable characteristics than, for example, gold or property, and you don't have to take leverage to buy it. Whereas a property, you need the leverage. You can't buy $20, $100, $1,000 of a property, right? You need to go to the bank, and it's such a big thing. With Bitcoin, you can do that. With stocks, you can do that. 25% annual rate of return. It's been 150%, but it's not gonna annualize at that, right? So let's just bring it down to 25%, which is way below the current rate. The current rate is around 50% a year. I'm gonna halve that and just say Bitcoin's gonna have a run rate of around 25% a year. The inflation rate of Bitcoin is 0.9%, but it's going down to zero. But Bitcoin is not a currency, and it's not an equity. It is unique. It is digital capital. Okay, so it's digital savings, digital capital for people that just need to save that capital in essentially a non-corporate structure without that risk. Once that capital starts annualizing around 10 to 12%, maybe actually they'll go into other assets, etc., and they want to take more risk. But there is a huge market for people that just want to store money over time in something that is less risky. But the sweet spot trade in Bitcoin is that it's new and it's capitalizing now with a high annual rate of return. That will go down lower before, but we're in the sweet spot now because it's been invented during our time, and we can get in on the early run. Bitcoin is digital capital. It's fixed in supply. It's reliable, low cost, fungible. It's a medium of exchange, unit of account, and store of value. That makes it money. And it's the most fungible type of money in the whole world because it's worldwide digital. Everyone can own it. It's exactly the same thing across the world. It's pretty much the only one. Okay, you do have the US dollar, but as we've seen, the US dollar is not a store of value because it debases itself by 7% because it's not money. It's a fiat currency credit unit system. So Bitcoin is money. Okay, Bitcoin has desirable characteristics. If you're taking a 25% rate of return minus a currency debasement, you're making 17% returns annualized. This is Bitcoin versus property. Bitcoin, I'm not going to go through it. Bitcoin has a lot of desirable characteristics. The main question is Bitcoin going to remain somewhat desirable over the next 20 to 50 years, which is an investment time horizon? Again, as a money type asset, Bitcoin is the most desirable and it has the most desirable characteristics. You need to own something, okay? You need to get out of that fiat currency credit unit system because that system is designed as a debt system. Take the debt, pay off the debt. That works as debt and credit, but it isn't money and it isn't an asset. If you have savings, you have to be in something else. So house, if you can, but if you can't, something else. Equity is decent. Bitcoin just has a higher rate of return annualized right now. You need to be owning something that people care about and have their money tied up in. That way you'll be part of a group of people that have influence and can push the government for favorable outcomes towards their investment. We have seen one of the US election candidates going massively into Bitcoin and crypto. Why? Because they're donating to his campaign, because they have skin in the game and they have money to invest in lobbying government for favorable outcomes for their investment, right? You have a big group of people that have sway and can vote. And so the election candidates want to actually favor them, right? So you need to be part of some group that has a vested interest in the thing going up in value. People care about their homes, so they lobby government for favorable rules. Shareholders care about their equity, so they fire CEOs that aren't making money or buying back their stock. And people care about their Bitcoin as well. So what are you going to invest in? If you can't invest in a house, it has to be either stocks or Bitcoin looking at this. So you can make the decision about how much of each of those makes up your portfolio. There is a second part of this video as well, which goes more specifically into how to actually manage your own portfolio and set up that. I'm going to leave that for the crypto course. It's way long for a YouTube video. Check the crypto course below. Bybit deposit bonus down in the description as well. $30,000 deposit bonus. I'm James, this is Matthew G. Cheers for watching, and I'll see you in the next one.